discussing on various topics, and we tackle various questions concerning those topics. So remember that according to the examiners, how they said, in financial reporting, it's very easy to pass once you have the good approach of the relevant topics. So right now, you know that group accounting can't miss in your paper. We have financial reporting, cannot miss on that paper. We have, so I've talked about group accounting, which can't miss. I've talked about published financial reporting. So remember that the organization has to present various financial statements every financial year. So that is an income statement, statement of changes in equity, and a statement of financial position. So you need to know the approach they use in the presentation of those statements. So another topic which cannot miss in financial reporting is partnership. So partnership is divided into three parts, whereby we have the one for dissolution, so dissolution of a partnership, we have conversion of a partnership, and we have amalgamation. So remember that dissolution is on the case whereby the partnership is being, it comes to an end, whereby now the partners agree to appoint a liquidator who will realize or sell the assets of the partnership so that they will share what the partners are claiming. So in that scenario, you need to know how to do the statement of expense allocation. You need to know how to do the relevant books of accounts which are closed, because now dissolution, you are going to close the books. Then we have conversion. Remember, conversion is whereby now if we were in a partnership, we have a limited, which is under the Partnership Act 29. So it changes to its operation to a company, that is Cap 46, whereby you will find that it's converted to a company, whereby the operations of the partnership comes to an end, then you transfer them to a company. So again, you need to know how to prepare those books. Then finally, we have amalgamation, whereby two partners, ships, farms comes together to form one. So those are some of the major topics, including branch. So the last one is branch accounting. The branch accounting, whereby if we have an head office in Nairobi, there's another branch in Kisumu, or an international branch in the US or in another country. So you need to know the head office maintains the books of the branch, and the branch maintains the books of the head office. So how they transact. So we have major topics which are around 5. So you need to know how to do the questions from those topics. Group accounting, publish financial statements. Then we have, so I've talked about group accounting. We have publish financial statements. We have partnership, that is a conversion, amalgamation, dissolution. Then again, we have to, so we have group, we have published, we have a partnership, we have branch. So those are the 4 main topics. Then we have some of the topics which are very easy. I call them easy because they are tested. Being easy is not that they are not tested, they are tested. And the easy things are the one which makes you pass. So you are supposed to specialize on that. So you are supposed to specialize on questions concerning banking, how you prepare the statements of a bank. You are supposed to specialize on how to prepare the statement of an insurance, that is insurance firms. In case of farming, you are doing livestock farming, crop farming. How do you prepare the books of those relevant farms? Then we have a professional firms, like now for lawyers and accountants. Remember that the law firms hires accountants. What is the accountant going to do in those law firms? So you need to know how the books are kept for the professional firms, that is for the lawyers and accountants. Then we will talk about recess. That is recess now it's under International Accounting Standard 17. And finally, we have share-based payment transaction, which was introduced the other time. That is May 2018 to the syllabus, the same as with amalgamation. And that is the syllabus in general for financial reporting. So for today, I think we can do one question for group accounting. The next time, we do another one, maybe for published. So we do one, I give you one for assignment. So once I do one for group accounting, you do one. I check if you are capable of doing the question of that topic. We do financial reporting, partnership 1, then branch 1, then the others I will choose 2 topics other than banking, but I will do 1 question for farming and insurance, and that will be the end of the revision for this semester. You do the exam. So let us check a question I will do for let us check a question I will do for group accounting. So I will do a question direct, because now theory I can send it to you. Because if I can introduce theory, it can take the whole class. So, but under the question, once I will be doing the question, you could be able to understand what I will be doing. So 2016, I will do 2016. That is a, let me check on the past paper. So 2016, either December or so if I check on 2016, we check on 2016. So we can do May, that is a, we can do, that is a, we can do question 4. We can do May 2016 question 4. Yes, we can do that May 2016 question 4. So this one is the question for today. So May 2016 question 4. So this is the question. So it reads, Jamii Limited is a listed company operating in the service industry. During the year ended 30th April 2016, the company acquired 2 companies, that is Bora Limited and Njema Limited, as part of expansion plan. The following statements of comprehensive income relates to Jamii and investee companies, Bora Limited and Njema Limited, for the year ended 30th April 2016. So we have Jamii, we have Bora, we have Njema. So that is an income statement. The additional information we are told on 1st May 2015, Jamii acquired 80% of 1125, that is 1,125 million ordinary shares of shillings 10 each in Bora for 18,000. So the main thing here is all about, now we interpret this additional information one by one. So now I need your concentration. So it means that number 1, on 1st May 2015, Jamii acquired 80%. So Jamii is the parent, it acquired 80% of the 1125 million ordinary shares of shillings 10 each of Bora, which means that Bora, on that scenario, Bora is a subsidiary, because when a parent company like now Jamii, the one which acquires another one company which acquires another one, here Jamii is acquiring Bora. So Jamii is the parent, it's acquiring Bora. You are told up to 80%. So if it's up to 80%, we say that when a parent company acquires another company, between the percentage of 51 to 100%, the other investee company, like now here, the other investee company is Bora, is a subsidiary to the parent, because it lies between the percentage of 51 to 100. So it's 80%. So which means that they acquired shares, 1125 ordinary shares. Per share, it was going at shillings 10. So to get the relevant capital, ordinary share capital, you take 1125, you multiply with 10. That is the capital. To get the capital they acquired on that Bora Limited. 4 shillings, 18,000. 4 shillings, 18,000. 4 shillings, 18,000. So this is the amount they paid to acquire Bora, which we call it a purchase consideration. So we call it a purchase consideration. So as at that date, share premium. So as at that date means that as at 1st May, because the question starts the same way. The additional information, I mean, say on 1st May. So they have said as at that date, share premium account of Bora had a balance of 3750, while retained profit was 3705. So which means that the premium was that and retained profit was that as at 1st May 2015. Those dates are very important. So that is why they have said as at that date. Because when I will be doing goodwill, when I would be computing goodwill, remember that goodwill is all about purchase consideration minus share of net assets. But now net assets include all equity components, which are ordinary share capital, share premium, revaluation reserve, and this retained profit. So the revaluation reserve and the retained profit you are supposed to use is as at the date of acquisition of the relevant investee company. Like now in this scenario, when I will be doing the goodwill of Bora, the retained earnings I will use is as at 1st May 2015, because Bora was acquired on 1st May 2015. So I must check if they have provided the retained earnings as at that 1st May 2015. Right now, that is why they said as at that date in our second sentence, as at that date, 1st May 2015. Share premium was that 3750, retained profit was 3705. That is okay. It was as at the date of acquisition, which is 1st May 2015. So the retained earnings is okay when I would be doing goodwill. Number 2, on 1st November 2015, Jamii Limited acquired 50%. On 1st November 2015, Jamii Limited acquired 50% of 600 million ordinary shares of shillings 10 each of Njema for shillings 6,300 million. Let me explain that. It's the same thing we have explained in note 1, because now on 1st November, Jamii also again acquired another company up to 50%. Robert, when the parent acquires another company up to 50%, so the other company is called, just unmute yourself. Robert, I think unmute yourself.
It's a joint venture.
It's a joint venture.
Yes.
That is okay. So the 6,300 is? Yes, Robert.
Yes.
You can see
the PC.
Is purchase consideration. That is okay.
Yes.
Yes. So we can continue. As at that date, the share premium account of Njema had a balance of 1,500 million. The retained profit as at 1st May 2015 was 2085. So which means that as at that date, as at 1st November, as at 1st November 2015, as at that date, share premium was 1,500 and the retained profit was 2085. Then the profit of Njema accrued evenly throughout the year. So you consider the period. When they say accrued evenly, I will consider the period from the date when that investee company was acquired, Njema was acquired. The period, in short, that is the period you consider. Then they say investments should be accounted for using equity method. So Robert, you need to know that when you have a joint venture or when you have an associate, when you are accounting for those companies, for those two companies, always you account using the equity method, International Accounting Standards 28, whereby we always say that you first measure them with their initial. Sometimes you might be told to explain equity method. So it means that you initially measure them with the initial cost, you are discharged with post-acquisition profits, then again you raise impairment loss. So that is how you do the equity method. So that is what the equity method is. You recognize them with initial cost, you are discharged with the post-acquisition profit, or sometimes they say reserves, then you subtract impairment loss. So that is the equity method, which is used to account for associates or joint venture. Like now here we have joint venture, we don't have an associate. Associate is the percentage of between, if another company has been acquired by the parent, between 20 to 49. Number 3, on the date of acquisition of borrower, the property, plant, and equipment of the company had a fair value. On the date of acquisition of borrower, the property, plant, and equipment of the company had a fair value, which was in excess of the book value by 390, with a remaining useful life of 5 years. So we always say that this, in order to get something called revaluation, So revaluation is the difference between the book value, or we call it sometimes the carrying amount, the difference between book value, which is also called the carrying amount, and the market value. So the difference between book value and the market value is what is called revaluation. So for example, now you might have a calculator, like now here, this is my calculator. So this one is for the relevant company here. When I will be recording this calculator in my books, I can say now, for example, it has been in usage. We might record it at, let's say, 500. But in the market, this calculator is 1,000 or 1,200. You can see that the difference between 1,200 and 500, the book value is 500, market value is 1,200. So the difference is 700. Always the market value is higher than the book value. So the difference is what we call revaluation. So, but the examiner will give you this figure of revaluation direct. Sometimes, yes, he might went ahead to provide carrying amount, which is a book value, and again, he provides a market value or a fair value. So you take the two, you subtract. And sometimes he might say this, like now in this question, note 3. On the date of acquisition of borrower, property, plant, and equipment. Remember that it's all about fixed asset. Property, plant, and equipment of the company had a fair value. So fair value, which was in excess of the book value. So the fair value was in excess of the book value by 390. So which means that if the market value was 600, let's say the market value was 600, the book value will be 210. Because now the difference is, you are given the answer because they say it was in excess of the fair value by 390. So fair value which was in excess of the book value. They have said property, plant, and equipment of the company had a fair value which was in excess of the book value by 390 with the remaining useful life of 5 years. So first you have understood how you can be able to get revaluation. So you consider the two statements, you consider the two approaches. They can give you fair value, book value. You subtract the two. They can give you the answer direct by saying fair value was in excess of the book value by a certain figure. Or they can say it was below. The book value was below the fair value. The book value was below the book value was below the fair value by 390. So here they have said the fair value. Sometimes they can say the book value was below. The book value was below the fair value. That is okay. So in case of revaluation, it leads to depreciation undercharge. It leads to depreciation undercharge. Because on your scenario like now, the example of a calculator I used, I said in my books, I have recorded at 500. But in the market, this calculator goes at 1200. It's measurable in the market at 1200, which means that when I was depreciating my calculator as a fixed asset, I depreciated using 500 instead of the market value of 1200. So 700, which is the difference, was never incorporated in this computation of depreciation, which means that I undercharged depreciation by the figure of 700. So I need to get the depreciation of this figure 700 as my depreciation undercharge. Like now, the difference on this question was 390. So I need to get the depreciation of 390 because it was never used in computation of the relevant depreciation of the property, plant, and equipment. Just understand that. Revaluation leads to depreciation undercharge. Then something which is not here. So the opposite of this is now, for example, if we have a sale. This is an example which is not on this question. If we have a sale of a fixed asset, they always say sometimes a transfer, not even a sale, transfer of fixed asset at a profit. Let's say you are a company A, Robert, I'm company B, Edwin. So you sold a night, you are the parent, you acquired me up to 80%. During the year, you sold an item of property, plant, and equipment to me as your subsidiary at a certain figure, including a profit. So this fixed asset is not meant for resale. I will never resell it, but remember that I have paid you the selling price plus profit, which means that I will never realize the profit which you realized because I paid you. So in that scenario, you determine unrealized profit on fixed asset. Then out of that, we will get something called depreciation or overcharge. Because now that asset you sold to me, you had already charged depreciation on it. Then once you sell it to me, I will also include it in my assets and I will depreciate the same. So since we are group members, parent and subsidiaries are group members, so we have to avoid the profit understatement because of a depreciation overcharge. So sale of fixed asset leads to depreciation overcharge. Revaluation leads to depreciation undercharge. Number 4, the fair value of the net assets of Njema approximated the book value as at the date of acquisition. The fair value of the net assets acquired in Njema approximated the book value. So remember that the first one was concerning, note 3 was concerning Bora. Yes. The note 4, they are saying that the fair value of the net assets of Njema approximated the book value. So there was no difference, which means that the figure of the net assets in the books are the same figures for the fair value. So there is no revaluation on point 4. Number 5, during the year ended 30th April 2016, Bora sold goods worth 6,000 to Jamii. Bora Limited had marked up the goods by 25% above the cost. 1/4 of these goods were included in the closing inventory of Jamii. So in this scenario, you compute something called unrealized profit on fixed assets. How do we arrive on this? Let's say again you are A, I am B. So if you are A, then you are selling goods to me as your group member, as your subsidiary. So you sold goods to me worth 6,000 at a profit of 25% above cost. You included a margin. Then at the end of the year, 1/4 of these goods are included in my inventory. So I have only resold. When you were selling these goods to me, I paid you everything. But on my scenario, at the end of the year, I have not resold. I have not resold all of the goods. 1/4 is remaining in my stock by the end of the financial year, which means that out of that 1/4, there is a profit which I have not realized. That is why I say you compute unrealized profit on fixed assets. So in order to avoid profit overstatement, you have to adjust that one, where I will tell you when I will be doing the equation where you are supposed to adjust. The goodwill arising on acquisition of investee company and suffered impairment losses to the extent of 25% during the year ended 30th April 2016. The group policies to apply partial goodwill method. So the goodwill you will get, it has been impaired. It has reduced by 25% for both the investment. So once you get goodwill, you impair. So we say that assets, fixed assets are depreciated, but intangible, like goodwills, are impaired. Other intangible assets, like patents, trademarks, are amortized, but the goodwill is impaired. Other fixed assets are depreciated. Then they said the group policies to apply a partial goodwill method. It's not a must, they say that, but you need to know. How will you know? When you are computing goodwill, you either use full method or we use partial method. In order to use full method, you must be given a statement whereby they will say that the non-controlling interest, the fair value of non-controlling interest was a certain figure. So it means that the non-controlling interest must be measured at its fair value. So in order to use full method, you must be given the fair value of non-controlling interest, whereby the goodwill arising from that full method is attributable to the parent and that non-controlling interest. But now in our question, if there is no such statement that fair value of the goodwill was this figure, it means that you go for partial method, which means that once you are using partial method, goodwill is only attributable to the parent company. Yes, Robert, any question on the goals that I have done before I continue with the question computation?
No, I'm okay.
So you have been making short notes on what I've been preaching.
Yeah.
So requirements, you can see they need goodwill, they need a group statement of comprehensive income, then they need a statement of changes in equity. So you know that we are supposed to use partial method. So in order to use that partial method, so remember that we are going to do goodwill, and the goodwill, in order to use this goodwill first, you need to know that goodwill, how you compute it. Goodwill is equal to purchase consideration purchase consideration minus share of net assets. Share of net assets. So the share of net assets. So on this scenario, I have said that if there is no fair value, so in order to use full method, so we have two methods, either partial or a full. In order to use this full, you must be given fair value. You must be given fair value of NCI. NCI means non-controlling interest. These are the minority shareholders. So if you acquire a parent, for example, 80%, so not parents acquire another company up to 80%. Let's say A acquires B 80%. So in that B, remember that there is a 20% which is never acquired by the parent. So the 20% in that company which is not acquired by the parent is what we call non-controlling interest. The minority shareholders, they don't have a say in that business, but they need profit from those business. So we continue. So on that scenario, purchase consideration is the amount paid to acquire a subsidiary or other investing company. Net assets, you know, there are equity components. So we can start with Bora, because on this scenario, Jamii is the one which acquired Bora and Gem. So you can't compute the goodwill of Jamii itself. Jamii can't compute the goodwill of itself. Jamii is the one which is consolidating Bora and Gem. So you are right now, you are a Jamii. You are consolidating Bora and Gem so that you present one financial statement at the end of the financial year. So you are supposed to do the transactions of Bora and Gem. You consolidate them. So we do the Bora, so the goodwill of Bora. So obviously we use partial. They have already told you that. And it's not a must because we don't have the fair value of non-controlling interest in this question. So even if they could have ignored that last statement, we could have known it's partial. So we have a purchase consideration. Purchase consideration, note 1, 18,000, because they acquired 80% of 1125 ordinary shares of shillings 10 each for shillings 18,000. Rest net assets. Rest share of net. So net assets, you know that these are ordinary share capital, share premium. So on this question, remember that you were given an income statement and then additional information. So if you have a statement of this kind, so net assets, obviously, they would be under additional information because there is no statement of financial position. If they could have provided a statement of financial position, is when I could have said that we check under the equity and liabilities under that statement of financial position so that we get the net assets. But on this scenario, you can see they have provided them under the additional information. That's why they say Jamii acquired 80% of 1125 ordinary share capital. I will use initials, ordinary share capital. So ordinary share capital, 80%, remember that Bora was controlled up to 80%. 80% of what? 11. So remember that the shares were 1125. 10 per share was 10. So you take 1125, you multiply with 10. That's why I have 11 to 50. Then again, they said as at third date, which means that as at 1st May, share premium was, so the share premium was 37.50. So 80% of 37.50. 80% of 37.50. Then retained earnings or retained profit. Retained profit. Remember that I said this one, the figures must be as acquisition date. When I say as acquisition date, I mean the relevant retained earnings figure you are supposed to use here must be as at the date when Bora was acquired. And you know that Bora was acquired on 1st May 2015. That is according to note 1. Then sentence 2, they said as at that date, as at 1st May, which is okay. the retained earnings was, so the share premium was 37.50 and retained profit was 37.05. So that is very good. So 80% of 37.05. Then finally, you have to check if there's any equity, which is in the other additional informations. Like now, additional information number 3, there was revaluation for borrower, property, plant, and equipment. So revaluation. So revaluation reserve. So this revaluation reserve. So this revaluation reserve. So this revaluation reserve again must be. So let us make this column to be at the far end. So this revaluation reserve must be also as acquisition date. So the two of them, retained profit and reserves, that is revaluation reserve, the figures you use must be as acquisition date, when that relevant subsidiary was acquired. Like now, borrower here, borrower was acquired on 1st May 2015. Then note 3, they say on the date of acquisition, borrower, property, plant, and equipment of the company had a fair value which was in excess, of the book value by 390 on the date of acquisition, with the remaining useful life for 5 years, which is okay, is as at the date of acquisition, which is 1st May 2015. So 80% of 390. 390 is revaluation. I explained that. So I think Omar, I think you have the calculator. Robert, you have the calculator. So you can confirm. So 80% of, so I can say 0.8 times 11 to 50. So this is 9,000.
10,000.
And the second one?
3,000.
3,000.
Yes.
The third one?
2964.
2964.
Yes.
And the last one?
312.
312. That is okay. So the answer, goodwill?
I have not calculated that. 18.
That is 18,000.
That's 9.
9,000.
2724.
That is correct. So then once you have the goodwill, remember that the goodwill now is impairment. So that's why they said note 6, the goodwill arising on the acquisition of investee companies. So the investee companies are both Bor and Gem, had suffered impairment losses to the extent of 25%. So you take the 25%, you multiply with the goodwill you have, 2724. That is
681.
681. So that you have the net goodwill.
714.
So 2724 minus 681. That is 24? 20, not 24. 2043.
Yes.
So then now next, we can do the goodwill of Gemma. So remember again, it's a partial method, Robert. So we start from purchase consideration. The purchase consideration, you have the question?
Yes, I have.
Purchase consideration for this?
$6,300.
Yes. Then we raise share of net assets.
Yeah.
Ordinary share capital. You can see in that note 2 is 50% of
50% of 600.
6,000. 600 is
6,000. 600 times 10.
times 10, so that you get the total. So that is 3,000.
Yes.
Percent of that. Then they say the next thing, Robert, is the second sentence of that. They say that as at that date, share premium of Gemma had a balance of 1,500. Share premium, that one you just take the way this, 50% of
1,500.
750.
750, yes.
Next, we talk of a retained profit. So what
2085.
I mentioned something about retained profit. I said we use the figures
As at that date.
as acquisition date.
Yes.
When I say acquisition date, I mean that when this relevant investee company, when it was acquired. Like now, you can see that, Robert, our financial year ends on April. April.
Yes. 30th.
30th April 2016. So it means it starts on 1st May.
Okay. Yes.
1st May 2015. When was Gem acquired? November.
November 2015.
November 2015. Did they provide retained earnings as at that November?
No.
They said as at?
I gave the retained earnings as at 1st May 2015.
Which you can see here is when the year was starting.
August, September, yes.
When the year was
October.
starting.
So it's 10.5.
So now you consider up to the date of acquisition here. So from May to November, those are how many months?
6 months.
6.
6 months, yes.
So 6 months. So what you will do, you will just check profit for the year from the income statement. That is profit after tax for Njema. That is the profit for the year. Are you using 1365?
Yes, 65, yes.
So that is now for the year. So in order to get now the retained profit as at this date, that is as at November, when Njema was acquired, you just take, brought down of 2085, you add for 6 months.
6 months.
So you apportion 1365 for the next 6 months. So it's like 1365, half of that, then 2085 plus answer. I think you are getting 2767.5. So that is now 50% of 27. That is now the figure as acquisition date, 2767.5. So we multiply with 0.5. You can say I have 1383.75. So that is the figure. So for reserves, we don't have reserves for Gemma because they said note 4, the fair value of net assets in Gemma approximated the book value. So there was no difference. So if there was a difference, maybe according to note 3 is when we could have said that there is revaluation. But on this scenario, the fair value of the net assets approximated the book value. So what we'll do is just to compute to get goodwill, then we subject it to impairment. I think you are getting the same figures I'm getting here. 1166.
Yes, 1166.25.
Yes, then subject that to an impairment of 25% because they said both investee companies, which means that both of the companies were being impaired by 25%. 25% of your answer.
291.56.
291.56. So our net goodwill, you subtract that one from, so net goodwill. So say 1166.25 0.25 minus answer. 874.
Yes.
Something. So that is okay. So you have the first mark, 4 marks. So we move now to the second part of that question. That is all about income statement. So let me clear the whiteboard. So now after you have done goodwill, now the second part, they need an income statement. They need an income statement. So first thing you need to check when you are doing an income statement, you have to start from the structure. You have to draw the structure and the shareholding. So the structure and shareholding. Structure and shareholding, you can see that Jamii is the one which acquired those two companies. It acquired Bora and it acquired Jema. So it acquired Bora up to which percentage? 80%, according to note 1. Then it acquired Jema up to 50%, which means that Bora is a subsidiary. This is a joint venture. And now I need to check the dates so that I will see here any company was acquired during the year. So our financial year ends on April 2016. So it starts on 1st May 2015. Then Bora was acquired on May. It was acquired on May 2015. That is according to note 1. Bora was acquired here, which means that Bora is a full year subsidiary. Then Jema was acquired according to note 2, November. It was acquired 1st November 2015. So November, December to April, those are the 6 months. So it means this one is a 6 months. That is a 6 months not subsidiary, but joint venture. That is a joint venture because 50%. So that is a joint venture. So after doing that, now you can be able to present the income statement. So you say Jamii is the parents. Now you say Jamii Limited because now it's consolidating the other company so that it presents one financial statement. For now, you can see in this question, it has presented 3. We have 3 statements. So when you consolidate, you present 1. And that is the purpose of consolidation. You are consolidating so that you present 1 financial statement so that the other entities, so now you look like you are one economic entity. So we talk about group statement of comprehensive income. That is now for the year. So it was for the year ended. So our financial year was ending April 30th April 2016. 30th April 2016. So in that case, on that scenario, You start with revenue. The way it is, you start with revenue. The way the equation is, the way they have provided it, you start with revenue, cost of sales. The way the statement is in the equation. In case where there's changes, I would mention. So you start from revenue. So revenue, remember that for the parent is 102, 180. You add for the subsidiary, which is Bora, 52, 800. So that is 52, 800. So this one I could have presented in a bigger space because it needs adjustment. Just a minute. So it's a continuation. It's a continuation. It's only that I need enough space. So we are talking about revenue. So revenue, you take parent, that is 102. You add, so 102, 102, 180, 102, 180, you add 52, 800. So remember that you consolidate between parent and subsidiary because those are group members. So you don't consider GEMA. Anyway, we will only consider after, under GEMA, what you will consider, remember that after GEMA has paid tax, like now you consider 1365. After GEMA has paid tax, which is a joint venture, after it has paid tax, the parent will be in need of his income up to 50%, but for 6 months, and that is all. So after GEMA has paid tax, it will give the parent 50% of that profit, but for only 6 months. So most of the transaction we consolidate is for the other items, which we consider is for parent and subsidiary, which are the group members. So the only thing you would subtract here is intergroup sales. So intergroup sales between parent and subsidiary. These are group members. So you only subtract intergroup sales between parent and subsidiary. That is according to note 5. Bora sold goods to Jamii. So the goods which were worth 6,000, you can see note 5, 6,000. So that is the only intergroup sale you subtract between that parent. It must be between parent and the subsidiary, and it must have occurred in the financial year under consideration. The financial year under consideration here, it starts 1st May 2015 to 30th April 2016, which means that they said during the year April, which is okay, and it's between parent and subsidiary. Next, you talk about you are supposed to talk about the next thing is cost of sales. So the cost of sales that is 76, 635 plus 36, 990. Then now the next thing you are adjust under cost of sales, and these are the things you need to only know. You subtract these intergroup sales between parent and subsidiary. Then you are supposed to add UPS on closing stock. UPS on closing stock. Add that. So add this to the cost of sales. Then less UPS on opening stock. So you raise UPS on opening stock to the cost of sales here. So between the two, the only UPS we have, and here is profit on stock, is for the closing stock, according to note 5, because it's out of the goods which were sold. On that note 5, Bora sold goods to Jamii at a profit of 25% above cost. But you can see they are saying that did Jamii, because Jamii is the one which received these goods from Bora. By the end of the financial year, now you need to check if Jamii sold all these goods he received from Bora. They said the last sentence, 1/4 of these goods were included in the closing inventory of Jamii. In the closing inventory of Jamii. You can see that. So UPS is equals to unsold goods times profit margin. Unsold goods times profit margin. So remember that the 25% they have said is 25% above the cost. So when we are above the cost, that is markup. So that is, you have been provided with profit markup, which is 25%, which is the same as a quarter. So in order to get profit margin, you just add the numerator to the denominator. So 1/4, you add 1. But 1 is not a constant, it can be 2. So you could have said 4 plus 2, so that you get a fifth. So which means that unsold goods is a quarter of 6,000 times margin. So this is the unsold goods, times a margin of a fifth. So that is 6,000. You divide with 20. That is 300. That is the 300. So you add that. So if there was a UPS on opening stock, let's say now the last financial year, there was some goods which were sold, but were never resold by the company which received them. But the end of the last financial year, you could have subtracted. So rest UPS on opening. But there is no opening stock. There is no UPS on opening stock. Then the next thing you need to consider is depreciation overcharge, and undercharge. So depreciation overcharge, you subtract. Depreciation undercharge, you add to the cost of sales. So under the cost of sales, you subtract undercharge. You add undercharge, that is what I've said. Depreciation undercharge, you add. Overcharge, you subtract. So on this scenario, I said in order to determine undercharge, you must be given revaluation. That is how to determine undercharge. Like now, we have a revaluation of 390 according to note 3. Then now you have the 5 years. So you divide with the 5 years, the remaining 5 years. So if there was a percentage, you multiply. If there's years, you divide. So depreciation undercharge is all about revaluation. You multiply with depreciation rate. Or if you are given the useful life, you divide. Right now, this scenario. So 390 divided by 5, 78. So 78, we add. Then depreciation undercharge, not undercharge, but overcharge, you subtract. So depreciation or overcharge. And that is due to sale of fixed asset. That would be due to the sale of fixed asset. So the next thing, so once you subtract the two, you are supposed to get gross profit. You are supposed to get the gross profit. So once you have the gross profit, next in this question, I can see we have investment income. So the investment income, 584 plus 60. That is direct. Then we raise expenses. So the expenses we have is distribution. So distribution expense, you take 12, 810 plus 72, 60. The next thing is admin. Admin is 77. That is the case. 4815. Parent plus subsidiary. Now, what do you introduce before we subtract finance cost? You introduce the impairment. Robert, you introduce the impairment. The impairment was? Robert, give me the figures you have for Bora and for Njema. The impairment from the goodwill we have already done. Yes, Robert?
There is 681.
681 plus?
291.56.
291.56. That is correct. So up to that point, Robert, we have something like profit before. You can see we have ignored the finance cost. That's why it comes after this. Profit before interest and the tax. Profit before interest and tax. So interest is now the finance cost. This is now how the finance cost comes in. So the finance cost there we have 720 plus 600. Then after this, remember that we have not been. Remember that after this, we need now to introduce Njema before we subject anything to taxation. So I said this, we have not been considering Njema, but now the parent, that is Jamii, will receive his profit after Njema has paid tax. So you can see under the column of Njema, Njema's profit before tax was 22,010 shillings. He paid tax of 645. Then now the profit for the year, which is profit after tax, is 1365. So out of that profit of 1365, remember that the parent controlled that company up to 50% for 6 months. That is from November. So the parent will claim 50% of that profit. So share of profit after tax. Share of profit after tax in Njema. So that is 50% of that profit, which is 1365, but now for 6 months, for only 6 months. Remember that it was never controlled up to 12 months. Then now profit before tax. I'm saying profit before tax because we have not subtracted the tax of Bora and Jamii. Profit before tax. So profit before tax. So then now we need to raise the tax, the income tax. So we need to raise the income tax of Jamii and the Bora, which is 1530 plus 1125. Then now we have profit for the year. Profit for the year. Have you been computing from revenue?
Yeah, so revenue is 148,980.
148,980.
And then cost of sales is 108. 003.
Plus 108.
003.
If you subtract the two,
4977.
40, then 584 plus 60.
644.
644. 12 by 10 plus 48, 15. So that is 12, 18 plus 72, 60. 12 by 10 plus 72, 60. 20.
Investment income you are subtracting.
So this one you add, we don't subtract. That is wrong. We add, that's an income.
Yes.
That is correct. So the next, admin.
A minute. 1621. That's 48.5. 12,594.
So this one is the one we subtract.
Yes.
681, 259.56.
$972.56.
It was a 681 plus?
681 plus 291.56.
It was 291.
972.56.
That is okay. So now the profit before interest and tax, 4977 plus 644 plus 20,070, not plus but we minus.
$7984.44.
Yes, 7984.
0.44.
720 plus 600, that is 1320. Then this one?
6664.44.
The share of profit after tax in German.
No, sorry. This 0.5 times.
Remember, it's 50. You have to consider the 6 months. Then 50%
Yes.
of
3.1, 341.25.
Yes. So that is an income to the parent. So you add. So that is what he was receiving from that joint venture. Profit before tax.
7005.69.
7005.69. Then tax, subtract tax. That is 1530 plus 725.
4350.69.
The tax is
A minute.
26.55.
It's 26.55.
Yeah, so that you have the
.69.
0.69. Then after that, you can see in the question we have other comprehensive income of 530. Add that. Say, add other comprehensive income. Then you mention as revaluation of intangible assets, the 530.
.69.
That is correct. Then down there you say profit attributable. After getting that, say profit attributable to NCI. Then again you say profit attributable to parent. So you have said add the comprehensive, which is revaluation.
Yes.
So revaluation, that is it was comprehensive income. It was 530.
Yes.
So once you got a total income of
48.69.
So you say total comprehensive income 48.
8.69.
0.69. So after getting that, then you say now profit attributable. Profit attributable to NCI. Then again you say profit
Attributable to parent.
attributable to parent. So now how can you get the profit attributable to NCI? So remember that now NCI on this scenario, NCI is the portion which is unacquired in the subsidiary. So you can't take the percentage direct. Some students say that you take the percentage that is, for example, 20%, you multiply with this. So you can't do that. So first you need to adjust the profit. So we are doing our working to get this our working profit attributable. So we are looking for the profit attributable to NCI. So in order to get this, first you need to adjust. You need to adjust the profit after tax. Profit after tax in subsidiary. So you need to adjust the profit after tax in subsidiary. So you adjust by subtracting URES, UPS, and there is profit on stock if sales upstream. If sales upstream. I mean that when I say sales upstream, I mean that if the subsidiary was selling to the parent, because here now we are considering the profit of that subsidiary, which means that if that subsidiary was selling some goods to the parent, and the parent has not resold all the goods by the end of the year, and initially it paid everything to acquire those goods from that subsidiary, so the profit of that subsidiary will be overstated by what the parent never realized, because he never resold all the goods he received from the subsidiary. Then again, another thing which you raise, is depreciation undercharge. Because now if you undercharge your expense, profit is overstated. So you need to raise to bring the profit to its normal state. Then now you add depreciation or overcharge. Because if you overcharge your expense, profit is overstated. So you need to add back what you overcharged. Then finally you raise impairment. You raise the impairment loss. But if full method was used, to compute goodwill. Because now if you use full method, If you use full method, at least now you will get the goodwill from parent and from that of the NCI. So after getting that of the parent and the NCI, remember that we sum, we add together, then we impair. So at least the NCI will contribute some of the goodwill to the total value. But if it's partial, remember that if it's partial, NCI will never contribute anything, which means that we can't say that there is impairment if the NCI never contributed anything on that case. So on that scenario, we take profit after tax of that subsidiary, which is 2070 from the income statement. UPS was 300, but then we need to check note 5 if it was an upstream sale. It was an upstream sale because Bora is the one which sold to Jamii. So and we got 300. Undercharge was 78. This one. There was no depreciation overcharge because there was no sale of fixed asset. Then impairment loss was there, but we used the partial method. So the NCI never contributed anything. So 2070 minus 300 minus 78. So you have 1692. So 1692, this is now we call it adjusted profit. This is now the adjusted profit. So once you have the adjusted profit now, to get the profit attributable to that NCI, you multiply with the NCI percentage, which was 20. So you multiply with 0.2. So that is 338.4. So that is the one you record here. 338.4. And now to get what is going to the parent, profit attributable to the parent, you take the total, you minus that. So 4880.69 minus the profit attributable to NCI, which is 338.4, the one we have computed, so that we have 4542.29. So that is the 12 marks. So I think, Robert, you are okay. We can move to the part C. So part C, they are saying statement of changes in equity, group statement of changes in equity for the year ended 30th April 2016. So when you are doing a statement of changes in equity for group accounting, you only consider the retained earnings portion. Only consider, that is for the case of group accounting. Statement of changes in equity, only consider retained earnings. Only consider the retained earnings, which is different from published, because under published financial statements, we always consider all the equity components. We always consider all the equity components. So in that scenario, now we write the heading, that is Jamii. So we have a group statement. Group statement of changes in equity. That is for the year For the year ended when? 30th April 2016. So we start from balance brought down as per the statement, balance brought down. So retained earnings, balance brought down. So this is the retained earnings. So the balance brought down of that. So you take all the companies you have, Jamii, you take Bora, you take Njem, then you add profit for the year. Profit for the year, parent. So the profit attributable to parent, profit attributable to parent. Then now you raise dividends paid. Dividend paid. So dividend paid, that is all about by parent. So the dividends paid by the parent. Then again, you might have a negative goodwill. You add back. This is an income, negative goodwill. Up to that point, you have the retained earnings carried down. You have the retained earnings balance carried down. So something here, NB, before even I record the figures there, if the investee company was acquired, during the year, if it was acquired during or at the start. Say if the investee company was acquired during or at the start of the current year, under consideration, the retained earnings brought down, the one which is brought forward is 0. So remember that now, in order to have a brought down here, those investee companies must have been acquired from the previous year. But if they were acquired at this start or during this year, it means the retained earnings brought down is 0. That is why here, Gemma was acquired during the year and Bora at the start. That's why we have 0. Then dividends paid was not present. There is no negative goodwill. Profit for the year, the one which is attributable to the parent, Robert, it was 42.29.
Yes.
And then now we can check brought down. There was no brought down because maybe these companies are new, because I can't see anywhere they have mentioned that, which means that this is 42.29. So that's how you were supposed to do that question. 20 good marks. Any question, Robert?
Yeah, there is are you through with, there is the calculation of the 300,
We missed.
No, there's something I missed. Not actually the 300, the 338.4. There is a place, there's somewhere I missed it. If you can redo the 338 only.
The 338.
Yeah, the profit attributable to NCI.
You know,
yes.
You are okay with that adjusting up to 16. It was 1692.
Yeah, it was 1692.
So after that, remember that on this scenario, Jamii acquired Bora up to which percentage?
80%.
So NCI is 20, the percentage which is unacquired in that subsidiary.
Yes.
is what we call non-controlling interest, the minority shareholders.
Yes.
So that is the 20 you multiply with that. 1692 times 20%.
Mm-hmm. Is the 338.4.
That is correct.
Mm.
Any question?
Mm. Okay.
You're
I see
okay.
it. Mm.
So, Robert, I think we will do another one next time before I move to another topic. I can do next time one question which has a statement of financial position.
Yes.
But for now, is your past paper up to 2014?
Up to 2014. Let me see.
Hmm?
Let me see. 2015. Oh, I have up to 2015.
Oh, that is good. So now,
Let me check on another one.
So let me check on another one. If you can give it a try.
I have another past paper. Let me see whether it has 2014. I think so. Mm.
So there's a question there, I think, of the same kind, which you can try, either December or November. One of the group for December 2014, the question, yes, it's December 2014. Check a group question in that sitting. December 2014, a question of group accounting in that sitting.
Consolidated statement of comprehensive income. Question 3.
It reads,
Haste Limited purchased 80% of the ordinary share capital.
yes, that one. Try that.
Okay.
Nice weekend. We meet next time for more revision.
Yeah. Is there a class within the week?
I will arrange and let you know.
So
I will also share some theory to you.
So
me.
I was the only one.
Yes, you are, for FR, you are the only one. So no, no. Yes, you are the only student.
So